On May 5, 1999, firefighters responding to a blaze at a Greenwich, Connecticut mansion at 889 Lake Avenue found a fireproof file cabinet that had survived the fire. Inside, investigators later recovered a handwritten document that began with a numbered list of tasks. The first item read, "Launder money." 2 paper shredders had been running in the house for days, and the ash in the fireplace still held partially burned ledger pages tracking insurance company bond balances across 5 states. The man who had lived in that mansion was already gone, having fled the country with a portfolio of forged passports. But the question that the burned ledgers raised is the one this episode answers. How does a single individual operating without a securities license, without an accounting credential, and without ever appearing on the regulatory radar of any state insurance department, come to control the bond portfolios of 7 life insurance companies across 5 states? And how does he convert roughly $200 million of those portfolios into gold, diamonds, and wire transfers to Swiss accounts, while the statutory financial statements those insurers filed with their regulators continued to show the bonds sitting safely in trust? This is the architecture of the bond premium skim. The mechanism at the center of this case is not exotic. It is the investment portfolio of a small life insurance company, and specifically the custody and reporting structure that surrounds it. To understand how the fraud worked, you have to first understand what a life insurer's bond portfolio is supposed to do, and who is supposed to be watching it. A life insurance company collects premiums today against claims it will pay decades from now. The gap between those 2 events is filled by an investment portfolio. State insurance regulation requires that this portfolio be conservative. The bulk of it sits in investment-grade bonds, government and corporate, that generate predictable income and can be marked to a known value. These bonds are not speculative. The regulatory framework, embodied in the statutory accounting principles that insurers must follow, treats the bond portfolio as the backing for the reserves. The reserves are the liability. The bonds are the asset that offsets it. Now, the critical structural feature. State insurance departments do not custody these bonds themselves. The insurer either holds them directly or places them with a custodian, typically a bank trust department, and reports the holdings on its statutory annual statement, the document known in the industry as the Blue Book. The regulator reviews the Blue Book. The regulator relies on the reported balances. And the regulator relies on a second layer of verification, independent audit and custodial confirmation. Here is what the bond portfolio is supposed to do legitimately. It is supposed to be a transparent, liquid, conservatively valued pool of assets, segregated from the operating business, verifiable by a third-party custodian, and reported accurately to the state. The entire solvency regime of insurance regulation rests on one assumption. The assumption is that the assets reported on the Blue Book actually exist, in the amount stated, under the control of someone other than the people running the company. The record shows that Martin Frankel built his fraud on the systematic defeat of that single assumption. Frankel's career before the insurance scheme establishes the pattern. According to the SEC enforcement record, Frankel had been barred from the securities industry. In 1992, the SEC issued an order finding that he had misappropriated funds from investment advisory clients through an entity he operated. The bar meant he could not lawfully act as an investment advisor or associate with a registered broker-dealer. This matters structurally because everything that followed was designed to give Frankel control over investment assets without his name appearing anywhere that a regulator would look. The vehicle he used was a Tennessee-based entity called Liberty National Securities, and the device at the center of the entire scheme was a trading account. When an insurance company gives its bond portfolio to a broker-dealer to manage and to hold in a trading or custody account, the broker-dealer becomes the point of custody. The insurer's blue book reports the bonds as held in that account. The regulator confirms the existence of the bonds by confirming the account balance with the broker-dealer. What this means structurally is that whoever controls the broker-dealer controls the confirmation. The verification chain collapses into a single point. If the custodian and the thief are the same person, the confirmation that is supposed to be independent verification becomes a forgery generated by the perpetrator. That is the core of the bond premium skim. Let us build the architecture step by step. Step 1. The acquisition of insurers. Frankel did not start with insurance companies. He acquired them. According to the public record, beginning in the early 1990s, a series of small life insurance companies in the southern and midwestern United States were purchased by entities Frankel controlled or financed. The insurers were in Mississippi, Tennessee, Missouri, Oklahoma, and Arkansas. These were not large national carriers. They were small, often old, regional life insurance companies. Frankel structured the acquisitions so that his own name did not appear on the controlling paperwork. The purchasing entities, including a trust structure, obscured the ultimate beneficial owner. Why small southern life insurers? Because they had 3 features the scheme required. First, they had bond portfolios of meaningful size relative to their visibility, tens of millions of dollars each. Second, they were regulated by state insurance departments with limited examination resources, departments that did not have the staff to conduct frequent, deep, independent verification of custody arrangements. Third, the purchase prices were low enough that the acquisitions could be financed quietly. Step 2. The redirection of the bond portfolios. Once an insurer was under his control, the investment portfolio was moved. The bonds were transferred into the custody and trading arrangement with Liberty National Securities, the broker-dealer Frankel controlled. On paper, this was an ordinary business decision. A life insurer engaging a brokerage to manage and custody its bonds is unremarkable. The insurer's statutory statements continued to report the bonds as assets backing the reserves. The reported amounts were maintained. As far as the Blue Book showed, each insurer held a healthy bond portfolio of investment-grade securities. Step 3. The skim. This is the operative step. Once the assets were inside Liberty National Securities, under Frankel's control, the bonds were not held. They were liquidated and the proceeds diverted. The record establishes that Frankel transferred funds out of the insurer portfolios and into accounts he controlled, including accounts in Switzerland. The money was converted into gold coins, into diamonds, and into the financing of a lifestyle that included the Greenwich mansions, luxury automobiles, and a substantial domestic staff. But the insurers still had to file statements showing the bonds existed, so the reporting was falsified. The account statements that Liberty National Securities produced, the documents that purported to confirm the existence and value of the bond holdings, were fabricated. They showed bonds that were no longer there. The income those bonds supposedly generated was reported as if it had been earned. In some instances, according to the record, money from newly acquired insurers was used to paper over the holes in previously acquired insurers and to make the periodic payments that kept the appearance of solvency intact. What this means structurally is that the scheme had a Ponzi characteristic without being purely a Ponzi scheme. The bonds were real assets that had been stolen. The reported balances were fictions maintained by a forged custodian. And the cash flow needed to sustain the illusion, the claim payments, the appearance of investment income was funded in part by the proceeds of acquiring and looting additional insurers. Step 4. The concealment layer. Frankel understood that the weakest point in his architecture was verification. If any regulator, auditor, or examiner ever attempted to independently confirm the bond holdings with a genuine third party, the fraud would be exposed in a single phone call. So, he built a fake third party. The record describes the use of a purported charitable foundation presented as having a connection to the Vatican, as a vehicle to lend legitimacy and to explain the flow of funds. He also relied on the structural reality that Liberty National Securities, the entity confirming the holdings, was the entity he controlled. When a state examiner sought confirmation of an insurer's bond portfolio, the confirmation came back from Liberty National. The confirmation was authoritative on its face. It was also a forgery produced by the thief. Draw the org chart. At the top, Martin Frankel, operating under aliases, barred from the securities industry, named on as little paperwork as possible. Below him, a controlling trust structure obscuring beneficial ownership. Below that, on one side, 7 life insurance companies across 5 states, each filing statutory statements showing intact bond portfolios. On the other side, Liberty National Securities, the broker-dealer that purported to custody those portfolios and that generated the confirmations the regulators relied upon. And running underneath all of it, a pipeline of liquidated bond proceeds flowing to Swiss accounts, to gold, to diamonds, and back into the system to plug holes as needed. The genius of the structure, in a purely architectural sense, is that it placed the perpetrator at the single point where the verification chain was supposed to connect to an independent party. The custodian and the thief were one. Now we turn to the question that any forensic review must confront. This was not a sophisticated derivative scheme hidden in mathematics that no one could pass. This was theft of bonds from custody accounts, concealed by forged statements. So why did it persist for most of a decade? Where did the verification chain fail, and what would have had to be true for detection to occur earlier? The first failure point is the structure of state insurance regulation itself. Insurance in the United States is regulated at the state level. Each state insurance department oversees the carriers domiciled within it. There is coordination among the states through the National Association of Insurance Commissioners, but the primary examination authority is state by state. Frankel's insurers were spread across 5 states. No single regulator saw the whole picture. Each state department examined the insurer or insurers within its jurisdiction, reviewed the Blue Book filings for those companies, and had no automatic line of sight into the fact that the same hidden individual controlled carriers in 4 other states all custodied through the same broker-dealer. What this means structurally is that the fraud exploited the seams between jurisdictions. The architecture was a single integrated scheme, but the oversight was fragmented. A consolidated view would have shown one broker-dealer holding the portfolios of 7 insurers across 5 states, all of them ultimately controlled by the same beneficial owner. No regulator had that consolidated view because no regulator's mandate extended across the seams. The second failure point is custodial confirmation. The bedrock control that should have caught this fraud is the independent confirmation of custody. When an insurer reports bonds held by a custodian, the auditor and the examiner are supposed to confirm directly with the custodian that the bonds exist. The defect here is fundamental. The custodian was Liberty National Securities, and Liberty National Securities was Frankel. A confirmation request sent to the custodian was a confirmation request sent to the perpetrator. The control existed. The control was executed. The control returned a forged answer. For this control to have caught the fraud, the verification would have had to reach past the broker-dealer to the actual securities. That means confirming with the depository trust company or the relevant settlement system that the bonds were genuinely held in segregation for the benefit of the insurer, rather than accepting the broker-dealer's own statement. The record reflects that this deeper layer of verification was not consistently reached. The examination and audit practice of the period for small insurers using a broker-dealer custodian relied substantially on the broker-dealer's representations. The third failure point is the concealment of beneficial ownership. State insurance law includes a process for vetting the acquisition of control of an insurer, often called a Form A process. The acquirer of a controlling interest must file disclosures and obtain regulatory approval. Frankel was a securities industry bar subject. Had his name appeared on the controlling paperwork, the Form A review should have flagged him. The record establishes that the ownership was structured to keep his name off the documents and to present nominees and trust entities as the controlling parties. The vetting process can only screen the names it is given. When the true controller is hidden behind a trust, the screen examines the nominee and passes the nominee. For this control to have worked, the beneficial ownership analysis would have had to pierce the trust structure and identify Frankel as the person actually directing the entities. That requires investigative capacity that a routine Form A review of a small insurer acquisition typically did not deploy. The fourth failure point is the audit. Small insurers retain auditors. The auditors of these companies were positioned to verify the assets. The structural problem is the same one that defeated the regulators. The assets were confirmed through the broker-dealer, and the broker-dealer was the perpetrator. An auditor performing a confirmation procedure against a custodian who is in fact the thief receives a forged confirmation that satisfies the procedure as written. The procedure was followed. The procedure was defeated by the fact that the independent third party was not independent. Consider what detection would have required. It would have required at least one of the following. A regulator with a consolidated view across all 5 states, recognizing that one broker-dealer held all 7 portfolios. An auditor or examiner who insisted on confirming the existence of the bonds at the settlement system level, rather than accepting the broker-dealer's statement. A Form A review that pierced the trust and identified the barred individual behind it. Or a single document trail connecting the Swiss transfers back to the insurer portfolios. None of these occurred until late in the scheme, because each of them required a degree of verification beyond the routine, and the routine was precisely what Frankel had engineered the structure to satisfy. There is a further structural observation. The assets in question were bonds, which generate income on a schedule. A skim from a bond portfolio creates a recurring problem. The portfolio is supposed to throw off interest. If the bonds have been sold and the cash diverted, that income disappears. The scheme, therefore, had to fabricate not only the existence of the bonds, but the income they were supposed to produce, and it had to source the actual cash needed to make claim payments and maintain the appearance of an operating insurer. This is the pressure that drove the continued acquisition of additional insurers. Each new portfolio was a fresh source of cash that could service the obligations created by the prior thefts. The structure was not stable. It was a system that required continuous expansion to remain solvent in appearance. That instability is what ultimately set the timeline for collapse. A scheme that must keep acquiring new assets to service the gap left by old thefts is a scheme on a clock. The only question is what triggers the failure. Now we turn to the unravelling. The trigger, according to the public record, was a transaction that drew regulatory attention to the source of the funds. Frankel had been pursuing an ambitious expansion, attempting to acquire additional insurance operations and to channel funds through the charitable foundation structure with its claimed Vatican association. As the volume of activity increased, the scrutiny increased with it. State insurance regulators in the relevant states began examining the carriers and the unusual flow of investment assets through the single broker-dealer. The decisive sequence began when regulators sought to verify the bond holdings, and the answers did not reconcile. Once an examiner moves from accepting the custodian's statement to demanding independent proof of the securities, the forged confirmation cannot survive. The bonds reported on the blue books could not be located in the amounts stated. The portfolios that were supposed to back hundreds of millions of dollars in reserves were substantially gone. As the regulatory pressure converged in the spring of 1999, Frankel moved to destroy evidence and flee. This returns us to the cold open. On May 5, 1999, the fire at the Greenwich mansion brought firefighters into a house where shredders had been operating for days. The recovered documents, including the handwritten list beginning with the instruction to launder money and the partially burned ledger pages tracking insurer bond balances, became part of the evidentiary record of the scheme. The astrological charts and the to-do lists recovered from the property were widely reported, but the forensically significant items were the financial records. The ledgers tracking the bond balances across the insurers and the documents connecting the entities. By the time investigators entered the mansion, Frankel had fled the United States. The insurers he had controlled were placed into receivership and liquidation by their respective states. The receivers and liquidators began the work of establishing the size of the whole. The bond portfolios that were supposed to back the policyholder obligations had been looted. The reported assets did not exist. The federal response followed. The SEC's enforcement record establishes the securities fraud dimension of the scheme, consistent with the prior bar that Frankel had violated by continuing to control investment assets. Federal criminal authorities pursued charges encompassing wire fraud, securities fraud, racketeering, and money laundering. Frankel was located and arrested in Germany in September 1999, several months after the fire, travelling with a cache of diamonds and multiple passports. He was extradited to the United States. The record establishes the resolution. Frankel pleaded guilty to federal charges including securities fraud, wire fraud, and racketeering. He was sentenced to a term of imprisonment exceeding 16 years. Co-participants in the scheme, including individuals who assisted in the operation of the entities and the movement of funds, faced their own charges and resolutions. The losses to the policyholders and the state guarantee funds, the funds that step in when an insurer fails, ran into the hundreds of millions of dollars across the 5 states. The mechanism of collapse is worth stating precisely. The fraud did not unravel because someone discovered the Swiss accounts, and it did not unravel because the diamonds were traced. It unraveled because the verification of the bond portfolios was finally pushed past the broker-dealer's own statement. The single point of failure that Frankel had engineered, the custodian who was also the thief, held only so long as no one demanded proof from beyond that point. The moment the examination reached for independent confirmation of the securities themselves, the forged confirmations were worthless, and the absence of the bonds was immediate and undeniable. The structure had no second line of defense. Everything depended on the broker-dealer's statement being accepted. When it was not accepted, there was nothing behind it. This is the defining structural feature of the bond premium skim. It was not a fraud of complexity, it was a fraud of position. Frankel placed himself at the exact node in the verification chain where the insurers reported assets connected to the supposedly independent party that confirmed them. By controlling that node, he controlled the truth that every downstream gatekeeper relied upon. The regulators, the auditors, the policyholders, all of them were ultimately depending on a confirmation that came from the person stealing the assets. What does this case establish about the mechanism? It establishes that custodial confirmation is only a control if the custodian is genuinely independent of the party whose assets are being confirmed. When the custodian and the controller of the assets are the same entity, the confirmation is not verification, it is self-attestation by the perpetrator. The control has the form of independence without the substance of it. Every gatekeeper in the chain executed the control as written, and every one of them received a forged answer, because the design of the control did not test the one assumption that mattered, that the confirming party was not the thief. It establishes that fragmented jurisdiction creates exploitable seams. The scheme integrated 7 insurers across 5 states into a single architecture, while the oversight remained partitioned state by state. No regulator's mandate spanned the structure. The consolidated view that would have revealed one broker-dealer holding every portfolio existed nowhere, because no one was positioned to assemble it. It establishes that beneficial ownership screening fails when it screens nominees rather than controllers. The Form A process was defeated not by overpowering it, but by never confronting it with the relevant name. A barred individual controlled 7 insurers because the trust structure presented other names to the screen. The regulatory response that followed addressed these structural gaps. In the period after the collapse, the National Association of Insurance Commissioners and the State Departments strengthened the requirements around custody verification and the independent confirmation of insurer investment assets, with greater emphasis on confirming securities at the settlement and depository level, rather than accepting a broker-dealer's statement. There was increased attention to the vetting of acquirers of control and to identifying the beneficial owners behind trust and holding structures. The case became a reference point in examiner training for the specific risk of a custodian who is affiliated with or controlled by the insurer's own principals. The findings of this review are these. The bond portfolio of a life insurer is the backing for promises that will not come due for decades. Its integrity depends entirely on verification by parties who are independent of the people who control the company. Martin Frankel demonstrated that if a single individual can occupy both the position of controller and the position of custodian, the entire verification chain confirms a fiction, and it will continue to confirm that fiction until someone reaches past the custodian to the assets themselves. The bonds, when finally sought directly, were not there. They had not been there for years. The confirmations had said otherwise because the confirmations were written by the man who had taken them.